Good morning, everybody. Thank you for joining me today. My name is Amber Hines, and today we're going to be talking about planning for married couples with annuities and when you may consider each spouse purchasing a Medicaid compliant annuity. Some of the webinar today is going to be a review of July's webinar where we talked about traditional community spouse planning, but the ending portion of today's webinar will be talking more about non-traditional planning for married couples when we have an institutionalized person that has an IRA account. If you have any questions during today's webinar, feel free to type them into the questions portion of the dashboard. And also, if you would like a copy of the handouts from today's presentation, you can find those in the handouts portion for download. Again, my name is Amber Hines. I have spent the last 15 years working with elder law and estate planning attorneys across the country to help their clients qualify for Medicaid by using a Medicaid compliant annuity. I am insurance licensed in all states, and I also hold a Series 65 license with FINRA. I created Ashfur to assist advisors and attorneys with insurance-based pre-planning solutions as well as crisis planning solutions. And one thing that kind of sets my company apart is the fact that we only work with A-rated insurance carriers, and we're going to be releasing a new type of planning product in October of this year. So if you're interested in that, look for an email that will be coming out shortly. So today we're going to be talking specifically about crisis planning, Medicaid planning, where we have either one or both spouses that would need some form of long-term care. So they would be uninsurable for any type of pre-planning insurance-based solution. When we're looking at crisis planning and the goals that we're trying to achieve when we are trying to obtain immediate Medicaid eligibility for somebody, we're trying to convert countable resources or assets into non-countable or exempt assets in the most cost-effective, tax-efficient way. We're also trying to minimize or avoid estate recovery as well. When we look at the asset and income limitations for a married couple, the income limitations for an institutionalized person is that their income must be less than their cost of care, unless we're in a state that imposes an income cap. If we are working in a state that imposes an income cap, then typically if the institutionalized spouse's income exceeds $2,350 each month, then we must establish a Miller Trust or a qualified income trust. A community spouse may have unlimited monthly income. There are only 2 states right now, Illinois and New York, that do require if the community spouse's income is greater than a certain amount, they must contribute some of their income towards the institutionalized spouse's cost of care. But in every other state, the community spouse can have unlimited income without having to contribute any of their income towards the institutionalized person's cost of care. When we look at an asset limitation for a married couple, an institutionalized spouse can generally keep around $2,000. This number does vary from state to state. Some states are slightly more than this, and some states are slightly less, but 2,000 is the most common number. And then a community spouse or the well spouse is generally able to keep 1/2 of the couple's countable resources up to a maximum of $128,640. Again, this number does vary slightly from state to state, but the $128,640 is the most common number. So we're going to be looking at that in today's webinar when we're looking at numbers for the community spouse. Other assets that are going to be protected for Medicaid, the community spouse is able to retain the family home, an automobile, household goods, and personal property. Both spouses can have irrevocable funeral trusts or prepaid burial plans. And then in some states, IRAs are also a protected asset. Some states will protect both the community spouse and the institutionalized spouse's IRAs, and in some states it depends on which spouse owns it as far as whether it would be a protected asset or not. If your Medicaid clients do have excess resources and we are trying to establish immediate Medicaid eligibility, we would develop a Medicaid eligibility plan, which can include increasing or improving non-countable assets, such as making home improvements, buying a new car, purchasing prepaid burial policies, paying off credit cards, mortgages, or other debt. And then after all of these other items are taken care of, we can consider purchasing a Medicaid compliant annuity that complies with the Deficit Reduction Act of 2005. A Medicaid compliant annuity is always going to be a single premium immediate annuity. It can never be a tax deferred annuity because a tax deferred annuity is similar to a CD at a local bank where there is cash surrender value that is associated to a tax deferred annuity. So a tax deferred annuity is always going to be an asset for Medicaid planning purposes, whereas a single premium immediate annuity, or a SPIA as some people refer to it as, is designed to convert excess countable resources into an income stream. Once it has been converted from a lump sum of cash into an income stream, that income stream is considered to be annuitized, and it is an irrevocable annuitization. So we can't change the income stream once that has been established. As a result of the Deficit Reduction Act of 2005, immediate annuities that are used in Medicaid planning must meet very strict requirements. So there's hundreds of insurance companies out there that offer SPIAs or immediate annuities that convert countable assets into an income stream, but there's less than 10 insurance companies that offer a Medicaid compliant contract. A Medicaid compliant contract must have all of the items that you're seeing on the slide here. It must be completely irrevocable, meaning not only the income stream must be irrevocable, but the payee, the beneficiary designation, all of the items under the annuity contract must be completely irrevocable. It must also be non-assignable, meaning that we can't assign payments to a company like J.G. Wentworth or Peachtree. It must be actuarially sound, meaning that the annuity can be structured to equal the person's Medicaid life expectancy, and it can be for a shorter period of time, but we cannot exceed the individual's Medicaid life expectancy under the actuarially sound test. Also, the annuity must make equal payments, so we can no longer have a balloon style annuity. And also the state must be named as a beneficiary. And there's an asterisk there that is meaning that there are some exceptions to the state being listed as a beneficiary, which we're going to be talking more about throughout the webinar today. The different type of assets that can be used to purchase a Medicaid compliant annuity, it's really any type of account that a client has, whether it be checking, savings, CDs, stocks, bonds, brokerage accounts, whole life insurance, because of the cash value that is associated to a whole life insurance policy, non-qualified annuities, and then IRAs or retirement accounts. If your clients do have stocks or bonds or brokerage accounts that they're trying to transfer into a Medicaid compliant annuity, please know that those types of accounts will need to be liquidated to a cash position before they can be used to purchase a Medicaid compliant annuity. We can't do an in-kind transfer into a Medicaid annuity when clients have those types of assets. Also, if your clients have whole life insurance policies or non-qualified annuities that have pretty substantial deferred gain or interest that has built within those policies, we can do what's called a 1035 exchange of an existing policy into a Medicaid compliant annuity so that those tax consequences are spread out over whatever term is used to purchase the Medicaid compliant contract. First, we're going to be talking about traditional community spouse annuity planning with non-IRA funds. So this scenario is dealing with one spouse that is in a nursing home and the other spouse is remaining at home in the community. The goals when we're planning for a married couple is to first obtain immediate Medicaid eligibility for the institutionalized spouse by converting excess resources into an income stream. And we want to do this in a way that is not going to incur any kind of penalty period or private pay period. So we're trying to get Medicaid to start paying immediately by using a Medicaid compliant contract. We also want to provide the community spouse with peace of mind, as well as sufficient income and resources to maintain his or her lifestyle while in the community. So our married couple example is dealing with Roger and Nancy. Roger is 80 years of age. He has dementia and resides in a nursing home. He has monthly income of $2,000 per month. He is spending around $10,000 a month on his nursing home bill. And Nancy is his community spouse, who is 75 years of age, and she has monthly income of $1,000 per month. The couple have a home, a car, and $300,000 of non-IRA bank accounts. If the couple does nothing at all, they are going to exhaust their $300,000 of life savings within a 30-month time frame by spending $10,000 per month on Roger's nursing home care. When Roger passes away, Nancy is going to be left with limited assets and nominal monthly income unless they establish eligibility, Medicaid eligibility for Roger. First, we're going to calculate the spend down amount that this couple needs to spend in order to get Roger eligible for Medicaid. So Roger, as the institutionalized spouse, is going to be able to keep his personal property, a prepaid funeral policy, and $2,000 of the $300,000 in cash assets. Nancy, as the community spouse, is able to keep the home, the car, a prepaid funeral policy, personal property, and $128,640 of the $300,000. So when we add the $128,640 to the $2,000 that Roger is able to keep, their total protected or exempt assets that they can keep total to $130,640, resulting in a spend down amount of $169,360 that needs to be spent before Medicaid will start paying for Roger's care. We can eliminate the excess resources by purchasing a post-tax dollar Medicaid compliant annuity for Nancy. You'll note that the whole $300,000 of their spend down was all consisting of non-IRA accounts. So we would structure the $169,360 in a Medicaid compliant annuity for Nancy, where she is the annuity owner, the annuitant, and the payee. And based on Nancy being 75 years of age, her remaining life expectancy is 155 months, or 12.92 years. With annuities only being able to be structured for a whole number of months, 155 months is going to be the longest term that we could purchase the annuity for Nancy. So when we look at the monthly payout of $1,120 per month, we see that the total payout of $173,600 is slightly greater than the $169,360 that is going into the annuity initially, which is simply representing a small amount of interest that would be paid over the term of the contract. When we look at the parties to a community spouse Medicaid compliant annuity, in this case, Nancy is going to be the annuity owner, the annuitant, and the payee. And the primary beneficiary is going to be the state Medicaid department, to the extent that Medicaid benefits are provided on behalf of Roger. The contingent beneficiary could be the children, a trust, a charity, or whoever the couple chooses to name as a beneficiary. There are a few exceptions to the state Medicaid department being listed as the primary beneficiary. A minor or disabled child can be listed before the state, And also there are a handful of states that do allow for the institutionalized spouse to be listed as the primary beneficiary before the state as well. So if you do live in a state that allows for the institutionalized spouse to be named as the primary beneficiary, that just adds another layer of planning that could be done in the situation where you have a community spouse that passes away and the institutionalized spouse is still alive and they receive the remaining annuity amount. In that case, you could be looking at doing a half loaf type plan or continuing the payment so that the person remains on Medicaid. But that's another type of planning strategy that can be considered if you do live in a state that allows for the institutionalized spouse to be named before the state Medicaid agency. Many people ask why Nancy is the spouse that would be purchasing the annuity and not Roger. So Medicaid does not impose any kind of transfer penalties for transferring assets between spouses. The community spouse in most states, like I mentioned, can have unlimited monthly income without having to contribute any of their income towards the institutionalized spouse's cost of care. So if we instead purchase the annuity in Roger's name and we were dealing with non-IRA assets, then the income that's being generated from the Medicaid compliant annuity could go towards Roger's cost of care if it is not shifted over to Nancy under the monthly maintenance needs allowance calculation. So the MIMNA, or the monthly maintenance needs allowance, is the minimum amount of income that the community spouse is entitled to. So generally, when we're dealing with non-IRA assets, we're looking at purchasing the annuity in the name of the community spouse because we can get all of that income back to the community spouse without having to contribute that income towards the institutionalized spouse's cost of care, which we're going to talk more about when we go through the actual calculations here. So the income calculations, when we look at Nancy's Social Security income of $1,000 a month, plus her Medicaid compliant annuity because she was the owner and the payee, we created $1,120 per month by way of the annuities so that she has monthly income of $2,120 per month. In the state that Nancy resides in, her monthly maintenance needs allowance, or the minimum amount of income that she would be entitled to, is $2,155 per month. So we see that Nancy actually has a shortfall of $35 per month from the minimum that she would be entitled to. So in this case, she is going to receive $35 a month from Roger. And when we're determining Roger's copay to the facility, we would be looking at his Social Security income of $2,000 less the $35 that would be shifted to Nancy, and also subtracting out $50 for Roger's monthly personal needs allowance, which would allow him to get a haircut or pay for things that Medicaid is not going to pay for. So when we deduct the $35 and $50 each month from Roger's Social Security income, we see that his copay to the facility is going to be $1,915 per month. And this is the screen that if we were to create the annuity in Roger's name and we added the income to his side of the equation, then we're going to be looking at paying potentially more to the nursing home versus if the annuity is in Nancy's name, then she can just keep all of that monthly income. So the economic results of purchasing the Medicaid compliant annuity, Roger and Nancy were expected to pay $10,000 per month for his care. We were able to reduce the copay down to $1,915 a month, which equals a monthly savings of $8,085 per month for this couple. The advantages of the Medicaid compliant annuity plan, we were able to obtain immediate Medicaid eligibility for Roger without any kind of penalty period or private pay period. We also created sufficient monthly income for Nancy through the Medicaid compliant annuity so that she can continue living in the community. The potential disadvantages of the 155-month annuity is if Nancy does predecease the term of the annuity or she dies before the 155-month time frame is over with, the state, assuming they would be named as the primary beneficiary, would be entitled to the amount of Medicaid benefits that they provided on behalf of Roger. And in order to reduce the likelihood that Nancy would predecease the annuity term, we could consider shortening the term to something less than the full life expectancy of 155 months. If we do shorten the term to something less than 155 months, then in that case, Nancy is not going to receive any of Roger's monthly income because her income in that case is going to exceed what the MIMNA is in that case. So the impact on the Medicaid compliant annuity when each spouse passes, since Roger is not going to be listed anywhere on the annuity contract other than to the extent that Medicaid benefits are paid on his behalf, Roger passing away does not have a direct impact on the annuity policy. So if Roger passes away, then the payments are simply going to continue to pay to Nancy for whatever time frame we took the annuity out for, unless Nancy predeceases the term. If Nancy, the community spouse, passes because she is the owner and the annuitant, the Medicaid department as the primary beneficiary would be entitled to receive the amount that they paid, and then the secondary or contingent beneficiaries would receive whatever is remaining in the annuity contract. The steps to secure Medicaid eligibility through the use of a Medicaid compliant annuity: we first want one spouse to enter a facility so that the snapshot date can be established. After the snapshot date has been established, we would determine the spend down amount or the amount that needs to be converted into non-countable assets. The Medicaid compliant annuity can be purchased with the spend down amount, and after the annuity is purchased, a Medicaid application is completed and submitted to Medicaid. So this first case study applies when we have a couple that has the majority of their countable assets consisting of after-tax or non-qualified funds, so money that's sitting in checking, savings, CDs, or other assets that have limited tax consequences for transferring the assets between spouses, and also in situations where the couple is seeking to obtain immediate Medicaid eligibility. Now we're going to consider a fact change where the institutionalized spouse owns an IRA, and we're not just dealing with a situation of all non-IRA accounts. So in our original example, the couple had $169,360 of a spend down amount, and this was consisting of all non-IRA accounts. So Nancy was the spouse that purchased the non-qualified or post-tax dollar Medicaid compliant annuity. But if we look at another scenario where part of the spend down amount of $169,360 consists of Roger's IRA that is valued at $100,000, and Roger is the institutionalized spouse. If we're looking at a state that considers Roger's IRA account to be a countable asset, which most states will consider the institutionalized spouse's qualified account to be a countable asset, then the real problem asset becomes Roger's qualified account, because we can't change ownership from Roger over to Nancy without the couple having to incur immediate tax consequences for changing ownership of a pre-tax account that has never been put through the taxation system. So the three different options that we would have available when you have an institutionalized spouse that has a retirement account that is considered to be countable in your state. The first option is to liquidate the IRA, pay the taxes, and purchase a non-qualified post-tax dollar Medicaid compliant annuity that's owned by the community spouse. So in this case, the couple is going to pay all of the taxes up front to get after-tax dollars over to Nancy. The second option is to roll over or transfer Roger's IRA and purchase an IRA Medicaid compliant annuity that's owned by the institutionalized spouse, and the payee is also the institutionalized spouse. And finally, the third option would be to try and use name on the check rule, where we are doing the same thing as option number 2. We're using an IRA Medicaid compliant annuity that's owned by the institutionalized spouse, but the payee is going to be the community spouse. So option number 1 is to liquidate Roger's IRA and pay all of the taxes. When all of the taxes are paid, then the money that is used to purchase the annuity are all non-qualified or post-tax dollars. So if we assume that the couple pays 22% tax on Roger's IRA that was valued at $100,000, the couple, after they pay $22,000 in taxes on Roger's IRA, they would have approximately $78,000 as the net amount or the after-tax amount to shift over to Nancy in order for her to purchase a non-qualified Medicaid compliant annuity. The couple would lose the $22,000 immediately by paying the tax bill, and after Roger liquidates the IRA, pays the taxes, now all of the couple's assets are in a post-tax dollar form. So Nancy's non-qualified Medicaid compliant annuity, she can now purchase one non-qualified Medicaid compliant annuity similar to the first scenario that we went through, where Nancy's Medicaid compliant annuity would be funded with $69,360 plus the net amount of $78,000 after paying $22,000 in taxes. So the total amount of the MCA in this scenario is going to be $147,360, which we know is less than the first scenario because we paid all the taxes up front. Again, her Medicaid compliant annuity can be structured for 155 months, which is her life expectancy, or a shorter period of time, but we can't exceed what Nancy's Medicaid life expectancy would be. The $147,360 would be immediately eliminated by purchasing a post-tax dollar Medicaid compliant annuity for Nancy. As you can see here, Nancy is also in this scenario going to be the annuity owner, the annuitant, and the payee. And the annuity is going to be structured over her full life expectancy of 155 months, so that the total payout is slightly more than the single premium of $147,360, equaling a monthly payment of $970 per month. The parties to Nancy's Medicaid compliant annuity are going to be exactly the same as the first scenario, because we are still using after-tax dollars to purchase Nancy's Medicaid compliant annuity. The income calculations here are going to be similar to the first scenario, but the Medicaid compliant annuity payment is slightly less because of the taxes paid up front. So if we add the Social Security income at $1,000 per month, plus Nancy's Medicaid compliant annuity at $970 per month, her total income is $1,970. And with this amount being less than Nancy's monthly maintenance needs allowance of $2,155, she has a shortfall in this case of $185 per month. So we can see that Roger's copay is going to be his $2,000 Social Security income less the $185 that shifted over to Nancy, less his $50 personal needs allowance. So his copay to the facility is $1,765 in this scenario, which is slightly less than the first option. Roger and Nancy were again expected to pay $10,000 per month for his care. We were able to reduce the copay down to $1,765 so that the couple experienced a monthly savings of $8,235 per month. The advantage of using option one and paying all of the taxes up front is that we know that this is a safe option, that Medicaid approves this type of strategy. There is no question about the ability to transfer assets between spouses from Roger over to Nancy. So it's the safest option out of the three. We were still able to obtain immediate Medicaid eligibility for Roger, and Nancy still receives a portion of Roger's monthly income through the MIMNA calculation each month. The disadvantages of option one is obviously having to pay all of the taxes up front. So when we're dealing with a larger IRA account, if you are in a state that does not allow options 2 or 3, then if you're looking at having the clients pay a large amount of taxes up front, we need to consider how long the institutionalized spouse is actually anticipated to live. Because if we're looking at paying $50,000 or $100,000 in taxes up front to get the money over to the community spouse, and the institutionalized spouse only lives for a couple of months, the family is going to be pretty upset when you have them pay this large tax bill up front, and then we only get a couple months of Medicaid eligibility as a result of paying all the taxes up front. Another item to consider when clients are going to pay the taxes up front is that a portion of their Social Security benefits may become taxable, and it may also increase their Medicare premiums if their income increases drastically by liquidating an IRA to shift it over to the community spouse. Option number 2 is to use an IRA Medicaid compliant annuity that's owned by the institutionalized spouse and have the institutionalized spouse be the payee of the annuity. So rather than liquidating Roger's $100,000 IRA account and paying the taxes up front, Roger is going to use the $100,000 IRA to purchase an IRA Medicaid compliant annuity over his life expectancy. So in order to convert Roger's IRA account valued at $100,000, we would transfer that account either through an IRA transfer or an IRA rollover into an IRA Medicaid compliant annuity. Also, the community spouse, Nancy, would need to purchase a post-tax dollar Medicaid compliant annuity in order to spend down the remaining $69,360. We can't mix pre-tax dollars and post-tax dollars in the same annuity contract together. So we would be looking at doing 2 separate annuity policies here, where Roger would be the owner and the payee of the $100,000 IRA Medicaid compliant annuity, and that would be structured over his life expectancy of 99 months based on his age of 80 years of age. And the monthly payment on the annuity would be $1,100 per month. Nancy would purchase a second non-qualified annuity over her life expectancy, which would create $500 a month in income. And you see again that the total payout is slightly greater than the amount that is put into the annuity contracts. The parties to Roger's IRA Medicaid compliant annuity, we see that Roger is going to be the annuity owner, the annuitant, and the payee. And the reason being is that it must be a like-to-like transfer of the existing IRA account. Because Roger owns the existing IRA, he would also have to be the annuity owner of the IRA Medicaid compliant annuity. We see though that the primary death beneficiary is going to be Nancy in this case, which is an advantage in the event that Roger passes away. Nancy, as the spouse and the primary beneficiary, would have the right to roll over the remaining IRA amount into her own IRA if Roger passes away before the annuity is completely paid out. The secondary or contingent beneficiary would be the state Medicaid department, and then the tertiary beneficiary in this case is going to be the children, a trust, or a charity, basically whoever the community spouse wants to name as a remainder beneficiary in this case. The parties to Nancy's non-IRA Medicaid compliant annuity is going to be the same as the first two scenarios, where Nancy is the annuity owner, the annuitant, and the payee. The state Medicaid agency is going to be the primary beneficiary, unless there's an exception where we have a minor or disabled child, or we have we're working in a state where the institutionalized spouse can be named as the primary beneficiary. In the second scenario, by purchasing two Medicaid compliant annuity, Roger's monthly income is going to increase from $2,000 a month up to $3,100 per month. Nancy's income is going to increase from $1,000 a month up to $1,500. Her monthly maintenance needs allowance is going to remain at $2,155. So she has a shortfall each month of $655 per month. The $655 is going to be shifted to Nancy from Roger's monthly income of the $3,100, so that Roger's copay to the facility is going to equal the $3,100 less the $655 that is shifted to Nancy, less his $50 personal needs allowance. And we see here again that the copay to the facility for Roger is going to be $23.95 after we add the two annuity payments, the $500 to Nancy's income and the $1,100 a month to Roger's monthly income. In this second scenario, where Nancy and Roger were expected to pay $10,000 per month for his care, we were able to reduce the copay down to $23.95, so that the couple experienced a monthly savings in this case of $7,605 per month. The advantages of using option number 2, where Roger is the IRA annuity owner and he is also the payee of the IRA Medicaid compliant annuity, is that this also is a safe option that we know Medicaid will accept, because this is based on naming the same owner of the IRA as the payee. And also we're depending on the monthly maintenance needs allowance calculations to get a portion of the annuity income over to the community spouse. We were still able to obtain immediate Medicaid eligibility for Roger. Nancy in this scenario is going to have $2,155 each month to meet her needs. This amount could be more than the $2,155 if Nancy has excess shelter expenses that would potentially increase her MIMNA up to $3,216 each month. Nancy, as we mentioned, is going to be the primary beneficiary of Roger's Medicaid compliant annuity. The couple is going to pay very limited income taxes on Roger's Medicaid compliant annuity, because when we do an IRA rollover or a transfer, Roger is going to remain the annuity owner, and he's going to be taxed gradually on the annuity payments as the Medicaid compliant annuity would make payments each month. So in this case, their Social Security income does not become taxable and their Medicare premiums do not increase under the second scenario. The disadvantage of using option number 2 is that if Nancy's monthly income exceeds the MIMNA, then she is not going to receive any of Roger's monthly income, and all of that annuity income is going to go towards Roger's cost of care. Option number 3 is to use name on the check rule, which is using an IRA Medicaid compliant annuity that is owned by the institutionalized spouse, and we name the community spouse as the payee. Name on the check rule is a Medicaid concept that stands for the fact that income belongs to the person whose name is on the check. If we have a situation where both spouses' names are on a check, then typically Medicaid is going to assess half of that income to belong to one spouse and half of the income to belong to the other spouse. Name on the check rule is not at all an IRS rule, and it cannot be found anywhere in the IRS rules or regulations. The rule is used in situations where we have a married couple and the institutionalized spouse owns a qualified IRA account that must be spent down in order to gain Medicaid eligibility for the institutionalized spouse. The community spouse is named as the payee of the institutionalized spouse's Medicaid compliant annuity. So under this third option, Roger annuitizes his $100,000 IRA. He names Nancy as the irrevocable payee. This is going to be the same exact scenario as option number 2, where the IRA Medicaid compliant annuity payment for Roger is still going to be $1,100 per month. Instead of Roger receiving the Medicaid compliant annuity payments, Nancy is going to be named as the payee so that her name is going to show up on the check each month from the annuity contract. So really the only difference between options 2 and 3 is the person whose name is going to be on the check each month. Looking at structuring the 2 Medicaid compliant annuities, the calculations for determining the annuities are going to be exactly the same as the second option. The only thing that's different is you're seeing under Roger's $100,000 IRA annuity structure that Nancy is going to be the payee of the annuity contract. So now under option 3, the parties to Roger's IRA Medicaid compliant annuity, he's going to be the owner and the annuitant. Well, Nancy, the community spouse, is going to be named as the payee. She is also going to be the primary beneficiary on the annuity contract. One thing that is somewhat confusing is the fact that the federal rules for annuities outline that a community spouse can always be named as a primary beneficiary before the state Medicaid agency. That doesn't come into play all that often, other than in situations where the institutionalized spouse is the one that is purchasing the annuity. Then we can name the community spouse as the primary beneficiary before the state Medicaid agency. The parties to Nancy's non-qualified Medicaid compliant annuity is going to be exactly the same as the first 3 scenarios where we went through. She is the annuity owner, the annuitant, and the payee. The state is likely going to be the primary beneficiary unless there is an exception, a minor or disabled child, or if we're in a state that allows for the institutionalized spouse to be named before the state. The financial impact of using the 2 Medicaid compliant annuities where Nancy is the payee on both contracts. In this third scenario, Roger's monthly income does not increase at all. His Social Security income of $2,000 is the only income that he is going to be receiving under option number 3. That's because Nancy is going to be the payee on both annuity contracts. So Nancy's monthly income in this case is going to be $2,600 because we're adding the two annuity payments plus Nancy's income of $1,000 per month to get the $2,600 a month that she's going to receive in income. In this final example, her monthly income exceeds her monthly maintenance needs allowance at $2,155. So in this case, she is not going to receive any of Roger's monthly income. His copay to the facility is going to equal all of his income at $2,000 less $50 for his personal needs allowance, or $1,950 per month. The income calculations under this third example, we have Nancy's Social Security income at $1,000 a month, plus Roger's monthly payment from his annuity at $1,100 per month, and her annuity payment at $500 a month equals the total income at $2,600 per month. And we see that because her income in this scenario exceeds her MIMNA at $2,155, she is not going to receive any of Roger's monthly income. So his copay is the $1,950 after deducting $50 from his Social Security for his personal needs allowance. The economic results of option number 3 is that Roger and Nancy were expected to pay $10,000 per month. We were able to reduce his copay down to $1,950 per month so that they experience a monthly savings of $8,050 per month. The advantages of using option number 3 is that Roger is immediately eligible for Medicaid. Nancy has monthly income, in this case, of $2,600 per month, which is more than her MIMNA. She is the primary beneficiary of Roger's Medicaid compliant annuity. So again, she could roll over the remaining annuity amount if Roger were to predecease the term. They're going to pay limited federal income taxes because Roger, again, even though we're naming Nancy as the payee, he is going to be the one that is receiving the 1099 from the insurance company, and he's going to be taxed gradually on the annuity payments. Their Social Security under this scenario does not become taxable, and their Medicare premiums do not increase under this third option. The disadvantages of using name on the check rule is that there's an increasing number of state Medicaid departments that have started to challenge this rule, and they don't count the income to belong to the community spouse. So if you're in a situation like that where the state Medicaid agency is not considering the community spouse to be the owner of the annuity payments, then that is going to increase the amount that the institutionalized spouse is going to have to pay towards their cost of care. And if the rule is challenged by the state Medicaid office, there's really no IRS law to justify naming the spouse as the payee on a qualified account. The only way that that really works is to try and use in-marriage quadro, where you're actually transferring ownership of a qualified account from one spouse to another. In summary, if we look at the differences between using option number 2 and option number 3, name on the check rule really only provides an economic advantage when the community spouse's income exceeds what the monthly maintenance needs allowance is. If the community spouse's income is less than their MIMNA, then we can go with option number 2 because they're going to receive the income from the annuity by shifting that income over through the MIMNA calculation. You see on this screen that if the community spouse's income is greater than their MIMNA, then the community spouse doesn't receive any of the institutionalized spouse's income. Whereas if the community spouse's income is less than the MIMNA, then they're going to shift some of the institutionalized spouse's income to make up for the MIMNA calculation so that the community spouse has sufficient monthly income. You're seeing here a map of the different states where name on the check rule has had favorable decisions. You're seeing that in orange. There are some states that are in black where we know the state does not allow for name on the check, which means that you're basically left with option 1, 2, or if you're in a state that allows for in-marriage quadro, you could consider doing that as well if you have a case where the institutionalized spouse owns a qualified account. In summary, some of the reasons why you may choose to work with myself and with Ashburn is that, like I said, I've been working with attorneys for the last 15 years on Medicaid eligibility for their clients. We do complementary case analysis to help you determine the optimal annuity amount, the term, and which type of assets should be annuitized. We only work with A-rated insurance carriers, and we offer top-notch customer service, getting back to people with proposals and with quotes usually the same day. And now I will answer any questions that people have. Okay, there is a question here about naming the institutionalized spouse as the primary beneficiary in front of the state Medicaid agency, providing advantages and disadvantages in doing so. So, like I said, one of the advantages of being able to name the institutionalized spouse as a primary beneficiary on the community spouse's annuity is if the community spouse predeceases the annuity term and the institutionalized spouse is still alive, the institutionalized spouse as the primary beneficiary would have the option to either continue the monthly payments and remain on Medicaid, or they could receive a lump sum of cash. And when they receive that lump sum of cash, that is going to exceed the $2,000 asset limitation. So in that case, you can decide to do a half a loaf type plan where you gift approximately half of the assets and use approximately half of the assets to purchase an annuity or a promissory note to pay through the penalty period. So that would be the additional planning opportunities that you would have available if you live in a state that allows for the institutionalized spouse to be named before the state Medicaid agency. Okay, there are some state-specific questions here about whether name on the check rule has been used in each state, which I can reach out to people directly about. There is a question about what do you recommend for clients with rental income. Generally, if there's rental income, we would want that income paid to the community spouse because the community spouse is going to be allowed to have more income that does not have to go towards the institutionalized spouse's cost of care. So generally, if possible, I would have rental income paid to the community spouse instead of the institutionalized person. And I believe that is all of the questions other than state-specific questions, which, like I said, I will reach out to you directly to answer. I want to thank everybody for joining me today for today's webinar. Make sure you look out for an email related to October's webinar, and I hope everybody stays well. And thanks again. Take care.